Hello, everyone. If you like distribution, this week is not disappointing. Yesterday, we saw some distribution going into the close. Today, certainly following through to the downside. Equities coming off, most risk assets coming off, even commodities coming off. Very few things are up. And I'll tell you what's down the most. Cryptocurrencies. We've talked about the bubble characteristics. Today, we're going to have a segment, Crypto Corner, where we dig a little deeper into what the signals are saying now. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message of the markets themselves. We focus on price action, and there has been plenty of price action to try and dissect today. Usually when we're prepping for the show, we're thinking of what themes have emerged and what sort of things to cover on a day like today. Our cup runneth over with different themes to touch on. There are a lot of different things. The general rotation from risk on to risk off, the overall move lower on risk assets, the gap lower on the S&P, and a lot of stocks certainly testing and or breaking down through key support levels. The fact that technology is leading the way higher today, or I guess leading the least lower today, had been actually in the green for some of the day, but rotating to the downside. Materials, energy, really feeling the pain, moving lower. Random stocks holding up okay. Stocks like Take-Two and others that target some earnings names that are able to bounce. And so, how do we make sense of all of that? That's what we'll try to do on today's show: is focus on some of the key themes. Now, we have some great guests coming up on this show. Yesterday, we had Joe Rabel from Rabel Stock Research. That was a lot of fun. Tomorrow, we have Katie Stockton from Fairlead Strategies joining us on the show again. Next week, we have a couple really good guests led by Louis Yanis coming up on Tuesday, the 25th. But two other events I wanted to point out to you coming up next week. All next week, we have a theme called Chart School. We are planning on having a new series of events in the coming months. Today, our next week's Chart School is going to be focused on generating ideas and the idea of idea generation using our scanning engine on StockCharts. We have 5 different experts that are each going to share with you the scans that they use every day, every week to try to make sense of the equity landscape, ETFs, and so forth. So it's going to be a lot of fun. Every day will be a different expert providing you their latest ideas. Also, we have our next episode of The Pitch. This is one of my favorite shows. I'll be moderating a discussion with Aaron Swenlin, Mary Ellen McGonigal, Danielle Shea. All of them are frequent guests and or hosts on StockCharts TV. All really know their stuff, and they're each going to bring 5 stock ideas with them. We'll have them each present them. We'll discuss them as a group. So that's coming up on May 27th. Let's get to our market recap. So we're going to go quickly through a lot of different things later in today's show. We have a couple segments that'll hope to fill in the blanks a little bit. One called Compare and Contrast, where we're focused on 2 stocks within the technology space. That's one of the sectors that was, one of the better performers today, although all of them were down. We'll also do a segment on Crypto Corner, where we'll focus a lot more on the sell-off in cryptocurrencies and how to make sense of that. From a technical perspective, stocks overall, the S&P finishing down right around 1%, not 1,000. Wow, that would be a rough day for stocks. 1% and down to 40.86 or so. Mid caps and small caps down even more, and mid caps actually led the way lower today. The Nasdaq 100 was one of the better performers out of our list of major indexes. The VIX, by the way, is back above 24. So we, had the VIX in the upper teens about a month ago and rotating back to the upside. And, people talk about that as the fear gauge. A couple of my guests in recent weeks have talked about the VIX and what that means. And overall, certainly elevated volatility, elevated uncertainty, elevated fear is what the higher VIX altogether sort of comprises. One of the very few things higher today, interest rates, with the 10-year yield approaching 170 again. And the idea of inflation has certainly been something we've been talking about. We're talking about the rise in rates and what that might mean. We've talked about looking at gold and what the rise in gold prices might mean. I think what we're seeing this week is that final recognition of investors of the prospects of inflation, the inflationary pressures, what that means for risk assets, and the general appetite of being more risk off than risk on. And a day like today, I think further validates that thesis a little bit. Interesting, by the way, my friend JC Peretz at StockCharts tweeted out this weekend after Barron's had their cover with inflation featured on the cover story. That's always an interesting moment with the when you see something pop up on the covers. The dollar, by the way, is one of the other very few things up today. The UUP was up about 0.5%. Very quickly, commodities down pretty heavily, with gold down the least, down about 1/3%, but silver down a lot more, and oil prices going lower, which is driving energy stocks down about 3.4%. Gold, by the way, if you look at the little 2-day preview chart, you can see it was up for much of the day, but really rotated lower, and the GLD closed more toward the lows of the day today. Cryptocurrencies is where you're going to see a lot of red. Bitcoin, surprisingly, was the top performer, only down around 10% from 24 hours ago. But if you look elsewhere, you'll see some dramatic downturns in things like Ethereum, Monero, Chainlink, some of these other coins. These aren't even the altcoins. These are some of the more major coins that are traded. Something like Dogecoin still down around 25-30% from yesterday. So certainly a lot of pain. And for me, when we get into Crypto Corner, we'll talk about cryptocurrencies as a gauge of risk appetite. And I think the sell-off in cryptocurrencies certainly completes the bubble-like characteristics that we've seen. We'd seen the left side of the bubble for a while. We'd seen some of the danger signs. Now we're seeing some follow through to the downside. So what's next? We'll get to that a little later. Let's focus on a chart of the S&P. So an interesting movement. Again, this is a pretty volatile day, but what we have been talking about for quite a while is the line in the sand using the trend line support and also the 50-day moving average. The blue dashed line you see here starts with a low in late October, reconnects with a low in March, and that connects very well with the low we had about a week ago, and also connects almost to the penny with today's close around 40.90. So we traded below this trend line support. We actually traded above it and closed right about at that point. So I would say we are there. I think the remainder of this week will tell us a lot about whether we continue to make a lower low. This is after making a lower high. And that, as you could probably guess, is Charles Dow's definition of a downtrend. So we're very close to having a confirmed tactical downtrend. A break below 40.50 would complete that. And it would also be a breakdown of the 50-day of trendline support. And I would argue, I think that indicates high potential to go materially lower than we're at right now. And again, the signs of topping patterns, the signs of exhaustion of buyers have been there. Things like the bearish divergence, things like the initial pullback, the rally that doesn't make it to the previous highs. But again, a day like today, sort of following through to the downside and seeing a broad sell-off across sectors and dragging down some of the things that are, trying to go higher, things like technology, which ended up being pulled down as well. I think that overall indicates some risk aversion. And again, the challenge with those things is once certain stocks break key levels, once the S&P breaks the 50-day, all of a sudden it starts to feel less like a buy on the dips kind of environment and more like a get out of the way environment. And that's when it's a feedback loop. The further things go, the further people want to take risk off. And that's what perpetuates these downtrends. That's how a 5% move can turn into a 10, 15+% move. And so I think we're there. I think we look through the remainder of the week to see if we get validation of a breakdown. By the way, our market trend model, and I was hoping to get to it today. We might get to that tomorrow, talk about this in a little more detail. But if the week ended today, you would have a negative, a bearish signal from the short-term indicator and also the medium term. And for me, the medium term is sort of that main risk on or off. This tells you whether or not to be looking for long equity ideas or not. And again, there's a lot of game left. We have Thursday and Friday sessions to see what happens. But at this point, the current bar would be a sell signal on both of those timeframes. We're thinking about a market recap. I'm looking at a number of different charts every day and getting asked about a lot of different charts. Something like AT&T pushing to the downside is concerning. Now, obviously, this is sort of an M&A thing. The big candle here was when they're talking about unwinding or unpacking the media side of their business and sort of reorienting things a bit. It's causing things to go lower. Monday's move was pretty distributive, followed by yesterday's sell-off, and then today you just get further follow through to the downside. So AT&T is oversold for the first time since back here. This is last fall when the market was in sort of its transition phase, but making a new multi-year relative low with today's sell-off. So overall, certainly distributive. The good news, if you're a dividend investor, is the dividend yield is looking more and more attractive. It's now over 7% because the prices come down so much. That's usually not my favorite way to be buying stocks. Other things to be looking at, things like the home improvement stores, Home Depot and Lowe's, both out with earnings in the last 24 hours. You had Home Depot before the open yesterday, Lowe's before the open today. And you're seeing both of those stocks come off. And this is actually as they've reported pretty decent earnings. So good numbers, but the price is coming lower. And so the expectation is, you've had lumber prices that have now turned, much lower than they were coming off of all-time highs, now coming back in recent weeks. You're seeing, general headwinds, concerns about inflation. Does that mean people are less, sort of this run of home improvement? Is that sort of the end of that as people are no longer having the appetite for that? But again, what I'm seeing from a technical perspective is a bearish divergence on both of those charts. Higher highs April into May, lower peaks in momentum, now testing the 50-day from above. And the question is it able to hold this? Lowe's actually just broke below it today. The question is, can a stock like Home Depot hold it right at RSI 40? So if all is well, and this is the buy on the dip sort of pattern, we're kind of there. If we break this going through the remainder of the week, stocks like this are unable to hold their 50-day, unable to hold RSI 40. I think that indicates more of a higher potential for deeper pullback and the need to start to get more and more defensive. We need to take a quick commercial break. We'll be back with my next segment, Compare and Contrast. We'll see you then. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. On days like this, when you see a lot of disruption, when you see big movements in asset classes across the board and a lot of stocks and cryptos and other things failing its support, it's always a bit of a question, a huge question mark on what's next. And I would argue times like this are when charts can be most helpful. Looking at what a stock does leading up to earnings, coming out of earnings, especially seeing this pattern that we've seen of sort of this sell the news mentality of companies reporting solid earnings, but the stock not going higher. I think that tells you about the overall risk appetite, which is pretty light. I think you're seeing more risk aversion than anything. And the sell-off in cryptos certainly seems to validate that today. We're going to get to that in a little bit. Before we do, I wanted to remind you, we'll do another mailbag segment on Friday's show. We'd love to answer one of your questions on the air. Shoot us an email, thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'll gather all of those questions and hope to answer a question from you on Friday's show. Also, as a reminder, go to StockChartsTV.com, use your email, set up a free account, start watching all of our great content from our fabulous hosts, our wonderful guests, and all their expertise, all featured. You can save, share episodes. You can bookmark certain ones that you're paying attention to. It's a great way to digest all the best of Stock Charts TV. Go to our website. We're also on all the app stores. Just search for Stock Charts TV on demand. Our next segment is called Compare and Contrast. What we like to do occasionally is look at two stocks in a similar group or similar theme and try to compare the two of them. I had Joe Rabel on my show yesterday. Joe's experience is very similar to my own in that he spent a lot of his career working with institutional investors. And what that means, for both of us has been, fielding questions. Should I buy X or Y? Should I be looking at Tesla or Peloton? And whatever random combination of groups or stocks or sectors or regions, it all comes up to this compare and contrast kind of mentality. I have the option, I have the ability to buy one of these two. Where should I be looking? So it's something we would frequently do to try to differentiate stocks. And so it's trying to give you a sense of what that might look like. To do this, we're going to use the gallery view function. So at the top, we're at the top of the StockCharts site, you'll see Sharp Chart. Click on that and switch it to gallery view. Now, if you put in one symbol, so if I put in Apple, it's going to give me a series of charts all on Apple. And this is the way to look at different time frames, incorporate the point and figure chart as well. If you put one ticker, a comma, and the second ticker, which is what we're going to do here, now we get to compare two stocks side by side. And this is a really cool way to do it. Now, my charts are most likely going to look very different from yours because I've clicked on this little button here and I've created custom templates. I've used the chart styles to create specific styles that I want to use for each of these. Yours, again, will look a little different. You can customize them to your own methodology. Click on the little blue button that says Learn How, and you can see how to use the chart style feature to create your own gallery view. We're going to jump past the intraday, which I usually do, and go to the daily charts of these two. So we have Apple on the left. We have Seagate Technologies on the right. Apple, as you know, hardware, software, app stores, all of the things. Apple is one of the largest stocks in the US, of course. Seagate is sort of in that group with Western Digital, WDC. These are hard drive manufacturers. So you might have a backup drive plugged into your laptop, and it might be a Seagate or Western Dig product, and that's sort of their business. So if you look at these two charts, it's great to look one to the other, and you can see how their return profiles have been very different. Looking at the daily chart, you can see how, especially in the last 6 to 8 months, they've had a very different experience. Now, Apple, for instance, really was rallying aggressively in the summer of last year. This is the summer of 2020, leading up to the market top in September. Look at how Apple topped out in September. We had this big bearish engulfing pattern, which I remember talking about. You may remember that one, and that sort of ushered in this consolidation period. So the chart of Apple looks very much like the chart of the S&P 500, sort of this narrowing of the range, a symmetrical triangle pattern, which resolved to the upside and was the push higher into the high in January. What also you can notice is how the stock was outperforming, right? So not only was it moving higher, but it was moving much stronger than the broad S&P. Compare that first third of the chart with what you see on the right side. Seagate was underperforming. It was actually going down while the market overall was appreciating. It was an underperformer, a severe underperformer going into the fall months. Now look at how all of that changed when Apple turned into its consolidation phase, hit a peak in September along with the market, and then sort of narrowed like the market itself did. Look at how Seagate just sort of took off. This is when the stock actually started to outperform. So recognizing when a stock is outperforming and underperforming versus its peers can be a really instructive part of your process. And I would argue it should be. Walter Deemer quoted me in his book as saying, I never look at a chart without relative strength on it. And that's true. If I ever don't, it's probably just a quick oversight that I neglected to do so. Let's update this and see what's happened there. If you look at Seagate for the last 9 months, it's been a fantastic stock, especially on a relative basis. Look at how the relative performance has increased. This is as the stock has been outperforming. Also look how the RSI has never really gotten below 40, which is characteristic of a stock in a good uptrend. Compare that to what we're seeing now with Apple, which is again a period of consolidation, much like a number of stocks in technology. You have lower highs and you have higher lows, and it's testing the 200-day moving average from above. My concern with the chart of Apple is if it breaks much lower than this, you're now breaking below the lower end of that pattern. You're breaking below the 200-day moving average. That actually measures a lot lower, down to something like 100, which would be a huge distribution, a 25% loss in a stock like Apple, which overall is just a big mega cap name, of course. So we're right at a key line in the sand for something like Apple. Seagate, on the other hand, has pulled back. Western Digital even more so, coming off of all-time highs. The concern with that is the bearish divergence of higher highs, lower peaks in the RSI. And the question is it able to rally from these levels and negate that bearish divergence? Support on something like this is down in the 82 to 85 region. That's the ascending 50-day moving average. So the question is, which of these two would you pick? I'd be very curious which of the two you would select, one versus the other. If you asked me to make my pick, I'd stick with Seagate. I'd stick with something that's been a relative performer. I'd stick with something that's shown its ability to outperform when the S&P outperform the S&P in sort of a bullish environment, but also has done well consistently versus something like Apple, which essentially has been an underperformer for the last 3 or 4 months. You're interested to hear what you would think looking at those two using our gallery view function. Our next segment is called Crypto Corner. As I mentioned, if you look at your charts today and you look for red, you go hunting for the color red, you are going to find cryptocurrencies at the top It is pretty rare that we've seen this sort of environment with all the cryptocurrencies. I mean, almost all of them. There are random altcoins that are probably flat to up, but most of the ones you would most likely be following, even Dogecoin, which has been a high flyer speculative play a lot of people have been asking about, overall, they're all down significantly. So, does it surprise me that in the last 24 hours, these things have come down so much? The severity of the move will always be sort of a shock. It's the signs that we've seen, I'm not surprised that you see these things going a lot lower. So am I surprised by this exact moment? Yeah, there was not anything in particular that told me this was the day when you would see a huge distribution. But for me, I think the signs, the warning signals have been glaring. We've been talking about some of them on the show. But I want to highlight a little of them in a little more detail. And to do so, we're gonna look at the chart of Bitcoin. Now, this is looking at the last year or so. This is going back to May of 2020, and I'm doing that just to highlight some of the movements that we've seen in cryptocurrencies and sort of the fluctuations here. To bring this up, by the way, we're using $BTC USD. Most of the cryptocurrencies, if you go to stockcharts.com/crypto, you'll see a full listing. We have about 150 odd cryptocurrencies that we have data for. And by the way, if there's something you don't see on our platform, we have a link on our website to request a symbol. Just let us know. We're happy to add it for you. So this is the chart of Bitcoin. And let's talk first about some of the warning signs, and then we'll talk about why a bottom around 30,000 makes a ton of sense from a technical perspective. And then we'll finish off with what may be next for Bitcoin and other cryptocurrencies. So first, what led up to this movement? Well, number one, we have this bearish divergence. Every high in 2021, every month, Bitcoin has made a new high, until May, right? January, February, March, April, you keep making a higher high. We can see how the relative strength is actually sloping downwards. It's the RSI. So you have a bearish momentum divergence pretty much across the board. Every higher move is met with lower momentum. Now, in general, the question may be, well, what about these where you just kept going higher? Totally fair. I think what's interesting about this last one is April. This is the first new high for the month, which was not met with an overbought condition. That's the real big differentiator. So in March, you even became overbought as you made new highs. This was the first time you actually did not have that pattern. So the sell-off that you've seen, the fact that we then made a lower high for the first time in a long time, going back here to probably September of last year, was very noteworthy, right? This lower peak in early to mid-May, indicated, I think, potentially a topping pattern. The real nail in the coffin for Bitcoin being an uptrend, in my opinion, is breaking through that swing low, right? A lower high, a lower low, as we've talked about with a lot of different charts, a change in trend from higher highs and higher lows and uptrended to lower lows and lower highs. That gives you a change of character. That tells you that the trend is over. By the way, the other noteworthy point is when we rallied here in early May, the RSI never got above 60, actually never touched the 60 level. And that is more characteristic of a bear market phase than a bull market phase. When things are good, the RSI pulls back to 40 and then rotates higher. In a bearish phase, it goes below 40, it gets to the oversold region, and then rallies don't get back up to the 60 level. And that's sort of what we saw here. So while this one particular day going down so much is certainly a huge change of character, and even worth noting, it was at 30,000 earlier today. It's all the way back to 40,000, a bit above there. But overall, the fact that we were moving lower is no surprise to me at all, given the warning signs leading up to this. So what about the sell-off today, and why did we bounce around 30,000? So a number of things that I would tell you. Number one, this is a perfect opportunity to use Fibonacci retracements. And I'll be able to go through just a minute of this, and then we're going to have to wrap the show. So if you're interested in this, by the way, I posted a video just today on my own YouTube channel called Market Misbehavior, where we talk about applying Fibonacci retracements, and we use Bitcoin as an example. We'll look at this one along with a couple other ones and how these shaded areas actually indicate a confluence of support and resistance. But the 30,000 level was interesting because if you take the low from September, you take the high of last year, you take the high from April of this year, about a month or so ago, and you take the retracements between there, 38.2% is just around 44,000. That lines up really well with the low from earlier in the year, around February. 30,000 and change, almost 31,000, is the 61.8% retracement of that September low. This is when Bitcoin sort of hits support here around 10,000, rotates higher. You can see that that overall, if you take that low and take that high, retrace 61.8% of the way, it's around 38,800, 900. And that also lines up with the lows from January. So what I like to do when you see a big move like this, start with the final bar as always and look to the left and see where we're at relative to key support and resistance levels. So 30,000 and right around there means it's a 61.8% retracement of the September to April uptrend. It is also right where we bottomed out in January. This is after that huge move higher up into the 40s, and then we came down and bounced right around 30,000 a couple times and moved higher. So once things sell off, the question is going to be, when do buyers come in? When are people done panicking? And when can you see some demand come right back in? The fact that it lined up beautifully with the January lows also happens to be a Fibonacci support level, makes this not a surprising level for something like Bitcoin to pop up. Final question, what's next? And I would say I've highlighted these two shaded areas, which show you sort of the potential range that we could see for cryptocurrencies. Interestingly, it's literally the range of this current price bar, going from 44,000 at the top to 30,000 at the low. That's a lot of movement for one 24-hour period, but that's the reality of where we're at. You can see the upper end of the range here around 44,000 or so, 42 to 44. This lines up with the lows from February, lines up with the Fibonacci resistance level, which also has served as support. On the lower end, around 30,000 to 31,000, 32,000, that's the Fibonacci level here, 61.8%. It's also the lows from January. I would argue, I would not be surprised to see Bitcoin trade around these levels, breaking out of this blue shaded area to the upside. Tells you there's enough demand coming back in that it's not just a buy on the dips, it's not just buying weakness, but it's more of potential sustained move back to the upside. And that's where you have to start looking at previous resistance. A break below the red shaded area is a bit more of a concern. And that's where I think you have to look at much deeper potential moves and retesting some of the previous lows. Around 18,000 is the last swing low here. But I think from a Fibonacci perspective, we will have broken the last support level down to a much lower level, about another 60 some percent drop off from where we hit lows today. That's a far way away, and we have to break one thing at a time. So I think looking at that range could be really, really helpful. That's how to put this sort of sell-off into proper perspective. Again, I think Fibonacci retracements can be helpful to look at a long-term time frame and look at how a current move relates to some of those long-term support and resistance levels. We need to wrap the show, go to the 3 and 3 charts, 3 minutes. Here we go. We start with the chart of gold, and we're using the GLD here. Gold has become overbought. Gold has hit its 200-day moving average, traded above it. Today, you have a very choppy candle. This is the second day in a row, sort of a doji candle for the GLD. That's when the open and close are right about at the same level. Overall, that indicates indecision. That indicates an exhaustion of the trend, and more often than not, you get a big pullback. So a pullback in gold coming off of an overbought condition makes perfect technical sense. The question is going to be, can we hold support? And if I extend this trend line from the March low and the April low, lines up to around 170, which also lines up from the low for last week. So I could see potential support right around there. Interesting to see how it's outperforming stocks coincidentally. Second, lumber prices. We've had some of the home improvement names, Lowe's and Home Depot, along with many of the big box stores reporting earnings this week. Both of those two stocks, by the way, reported earnings fairly constructive, actually pretty decent numbers. And both of them have seen the stock not really rally in the face of those positive earnings. It's actually come off. So it's more that investors are not buying the earnings, but selling the news of the good earnings. Also worth noting that lumber prices have come down pretty good in the last week. This is after a bearish engulfing pattern here at the very top, sort of a distributive pattern, a bearish outside day. From there, it's been falling very, very quickly with lumber futures coming down off of those all-time highs to a pretty good clip. That could be part of the story as well. Does this indicate an exhaustion that inflationary pressures may start to weigh on home improvement stores, on home builders, on lumber demand, potentially? So far, that's what we're seeing here. Finally, the chart of Apple. If I had one chart to get a sense of what's going on right now, I don't know if I would pick something better than Apple. Apple is in a consolidation phase. You have this consolidation similar to what you saw back here in September and October when the market was sort of in a rotational phase. You had lower highs and higher lows. Apple getting above the upper end of that consolidation phase, breaking out of that pattern to the upside, I think was one of the tells in those November into December, telling you that stocks overall had a good chance to go higher, which they certainly have. Now, once again, we're in this consolidation phase of lower highs and higher lows. We're at the lower end of that boundary, and we're testing the 200-day moving average as well. Apple is really close to giving a very negative signal that measures a lot lower than where we're at. it would measure down to around 100 at least. It's a minimum downside objective, which would also line up with the lows from September after that peak. That's a long way down from where we're at. It's about a 20-25% sell-off, but certainly has a potential. The concern I have is if stocks like Apple break down like that, what does that mean for the broader S&P? Folks, that is our show for today. Thank you so much for joining us as we make sense of all these markets together. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.